Hello and greetings. Welcome to our winter 2023 market update. I'm recording this in late January. Hope your start to this new year has gone well. I wanted to get some thoughts out to you from really our whole team on behalf of Kevin and Julia and Daniel and Kathy. Just want to help you make smart financial and investment decisions. And so here are some thoughts on kind of what's been going on in the market second half of last year and as we start this new year of 2023. So let's get started. I love this quote from Albert Einstein. He was not known as an investor. He was known as an inventor and a scientist, but he was correct when he said compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The reason this quote is so important to us on the Purifoy Wealth team is we really, if you're a client of ours, we really want you to be one of those people who get the compound growth and interest from your portfolio and who understand it. Because if you understand it, you've got a higher likelihood of being rewarded as a successful investor. People who don't understand what's going on out there in the economy and the stock market end up paying the price of that ignorance. And it's not that, if you're a client, you have to know everything. That's what you have us for. But we certainly want to keep you informed here as well. So let's take a look at this slide as we often do. The market, as you can see over in the far right, what this indicates is the stock market for 2022 was essentially down 19% for the year. That's this gray bar. It was down 25% at one time during the year. What this chart shows going back to 1980 is, as evidenced by the gray bar, which is the stock market total return for the whole year, is it's been positive 32 out of the last 42 years. And yet the red dot shows the intra-year decline. How much was the stock market down at some point during that year? Well, the average drop is 14%. So it would be a very true statement to say that the stock market typically takes 3 steps forward and 1 step back. The average of all those returns is about 10% since 1980. And yet the stock market on average goes down 14% annually. We've also circled 1987 over there on the left. That's a example we used a lot coming up preceding 2020 to reveal historically what can happen when the market dips a lot, but it's still positive for the year. Last year, the market dipped a lot and was negative for the year. So last year was a year not so much like 1987. It was a year more like 1990, where the market dropped 20% during that year and still ended the year down 7%. And then what we've also circled in the middle is you also have, as you've heard us say before, you have bad decades. Sometimes there are bad years like last year. Sometimes there are bad decades like the 2000s or the 1970s or the 1930s. That's a totally different situation altogether. And we'll talk about that in a different market update. So volatility is very normal, very healthy. Stock market, as we know, does not go up the same amount every year, not even close to it. But we're still with the question, how can we make smart decisions? One quick note on the elections of late last year. We had a midterm election. The average 1-year total return in the stock market is around 10%, going back to either in this slide 1950, going back to 1980 as in the previous slide, or going back even further. But after a midterm election, it typically is much, much higher. Now, it's really inconclusive as to why that is so, because the data does not suggest that the stock market likes a Democrat or Republican House and Senate any more than the other. So what we are left to conclude, at least in my opinion, is that sometimes the certainty of a midterm election and just knowing where things stand in Washington, D.C. can give investors, but maybe even more, maybe more of an impact. It might give executives at these large publicly traded companies that we invest in more confidence to know the rule. They know that they know the rules of the game and that they know how to strategize in their businesses at least over the next couple of years. So we'll see what happens with the stock market this year. This is a very telling slide. This shows inflation going back to the year 2000. We started talking about inflation in our market updates probably in 2020 when we knew it was coming. As you can see from this slide, it really didn't take effect until late 2021, and then it really peaked in September, late summer, early fall of 2022, which is where this data is from. And you can see that CPI, the Consumer Price Index, has averaged about 4% over the last 22, 23 years. And inflation jumped all the way close to 9% last year. That's what happens when you simply pump that much money into our economy. And now what's happening is they've realized they overdid it. And so this is a playbook and a lot of historical lessons that we can learn from, really going back to the late 70s, early 80s, where our country really dealt with the same issue, probably in a more extreme situation back then, and really more extreme measures. But the Fed is very simply trying to raise rates to essentially pull money out of the economy. That's why you're hearing a lot of talk out there about potential recessions that we might already be in. And the challenge with the recession is that you don't really know you're in it, or you don't really know it came until you're already in it. So just remember that the stock market essentially predicts the economy and not the other way around. So if we're thinking that, if we're afraid in terms of our portfolio that the economy is going to get worse, we're misguided. There's really not anything out there that tells us what the stock market is going to do, but the stock market essentially tells us a lot of times what's going to happen in the economy. So what this essentially means is that the economy can get worse while you see your portfolio go up. So let's not confuse the two. How does inflation affect your portfolio? This is a really critical slide for us to understand. What all I've really done is just kind of used like third grade math here. If stocks have averaged 10% over the long run and inflation has averaged about 4%, then essentially what we would call real return in finance investment class, real return after inflation, is essentially 6%. Well, here becomes really the challenge and the difference between stocks and bonds. If bonds average 4% and inflation is 4%, then you have a real return of 0. That becomes quite a challenge. Cash is even worse. Thankfully, money market rates are coming back up because of the what's going on with the Fed. But if cash was earning 2% and inflation was still 4%, then now cash is moving backwards at 2%. We're just taking the return of the investment class, subtracting inflation, and all that really does is that gives you a real picture of how hard the money is working, because the return is only one aspect. It's the return over and above inflation over time that really matters. So if you just focused on stocks and bonds on the top line, you might say, well, and there's a lot of people out there who are very misguided, who say, well, I'd be okay with just a 4% return from bonds. I don't have to have 10% out of stocks. The challenge is their real return after inflation is 0. So someone who's retired, who might have all of their money in bonds, not our client, but if they do, then essentially if they're pulling money out of their portfolio, they're going backwards every single year compared to inflation. And eventually they would run out of money. That might be a slow death financially, but it would still be a serious problem. Stocks, on the other hand, by earning 10% over the last several decades, they haven't really worked 2.5 times harder than bonds at a 4% return. They've really worked much, much harder than bonds, as evidenced by the real return. If bonds had even given you a 3% real return over above inflation, which they have at certain times, it would still be true that stocks work twice as hard as bonds in terms of your portfolio and helping you achieve your goals. The reason for that, I've used this example a lot. If the price of a lawnmower at Home Depot goes up by 10% over last year, Home Depot's still making money. If the price of eggs at Kroger goes up, Kroger's not real worried. They're going to pass that cost on to you. They know that they know they can still make money, a certain profit margin. off of selling groceries. And so Kroger's still going to make money. So in terms of how we think of our own portfolio, whether we are retired or not, we need to really be thinking more similarly to how these executives at these large companies that we invest in think. The more equities you own, the more inflation protection you have. That's essentially what I just went through. If, in contrast, if we loan one of those companies I just mentioned, if we loan them money and ask for a 4% rate of return, then we don't have any inflation protection. All we're asking for is a 4% rate of return. So if inflation's 9% and we earn 4, then we lost 5% forever. That does not happen, has never happened in a diversified stock portfolio, but it has happened many, many decades in portfolios that are heavy in bonds and cash. What I love about this slide, and this is no guarantee of future results, we all know that, but whether you are an aggressive investor and have all stock, or a ultra conservative investor and have all bonds, which would be the gray line, the all stock would be the orange line, you've really made money. This goes back to pre-Great Depression. You've really made money every single decade. We know that you haven't made money every single year, but you have made money every decade. The startling difference is in the top right of this screen, where even a balanced investor, as shown by the blue line, has 3 times more money and 3 times more inflation protection than a conservative investor, as shown by the green line. So what you hear us say a lot if you're a client is there is a risk to being too growth oriented in your portfolio, but there's an equally just as dangerous risk in being too conservative in your portfolio. We tell clients a lot, think of 2 guardrails on the road. You really don't want to hit the left guardrail that would be in the left lane going too fast and losing control, but there's a guardrail over to the right on the right shoulder where if your portfolio is really moving too slow, really regardless of your age, then there's a real risk there too, because you are not protected from inflation. Time is always on your side. If we just look at the 4 worst stock market declines of the last 100 years, they would essentially be the Great Depression, where the stock market went down 80%. We had significant debt. You could borrow a lot of money to buy stocks back in that day, and there was significant helpful federal regulation that happened in subsequent years to prevent that going forward. But you had an 80% decline in the stock market, and from kind of peak to peak, the decline and the rebound, it essentially took 8 years if your dividends were reinvested in your portfolio, which most people's are. The oil crisis, and there were some other things going on in the economy. 1972 through 1976, the stock market went down 40%. From peak to peak, it was 4 years. And then if we look at essentially what was the internet bubble combined with 9/11, it was really 2000 through 2006, you had a temporary decline of 49%, and it essentially took 6 years from peak to peak. And then you had the Great Recession of 2007, essentially through 2012, in terms of peak to peak in the stock market, and it was essentially 5 years. And in the middle of that, we had a temporary decline in the stock market of 56%. So these times are really, really painful. They can cause a lot of hurt and fear in investors. But the conclusion that we take from that is that historically market recoveries have taken months and years, not decades. So they don't take forever. Again, that's no guarantee of future results. But we need to remember that sometimes the stock market will test our patience. This is in no way a prediction of what's going to happen in 2023, but for the most vulnerable, let's say, of our clients, I'd say of investors out there, really for everybody, would really be the investors that are already retired. Those are the ones who typically have more reason to worry about their portfolio. But as long as you're controlling the withdrawal rate and you've back tested, or have an advisor team like us who has back tested your withdrawal rate from your portfolio against these difficult times in history, and as long as the result has been success, not some of the time, but all the time, that's really the only thing that could give an aware, informed investor confidence that that they don't have to go back to work if they're already retired, and that they're not going to run out of money, and that most importantly, their retirement income is going to be consistent, as in they can take it consistently, either monthly, quarterly, or annually, and it's going to rise with inflation over time. So I'm not going to go into a lot of detail in this market update with that here, because we do that on a case-by-case basis for all of our clients as a way of really protecting them financially. One thing that I want to close our time today in talking about is the emotional side of investing. This is a wonderful chart that comes from the author Chip Dodd, who is a friend and a colleague as well. I have a lot of respect for him in the really groundbreaking work he's done the last few decades in the emotional world. I think a lot of the work that Chip Dodd has done can really help investors and especially clients of ours be more successful. He highlights really 8 feelings, as in kind of the primary colors of what we feel, the musical notes that we experience on a daily basis. Some people ask, well, why is there only 1 positive, 1 and 7 negative? But what Chip so clearly explains is that when you start thinking about these 8 feelings in daily life, they start to make sense. They start to make as much sense as musical notes and primary colors. 1 + 1 = 2, 2 + 2 = 4, things like that. But what I think investors feel a lot are hurt and fear. The emotion of hurt is essentially kind of, in some ways, the pain that runs through all the feelings. It's like, ouch, that hurts. But internally, what can happen, and Chip highlights this in this chart, the impairment of hurt can turn into resentment. So a hurt investor can say, well, I resent myself for letting my portfolio go down 10% or 15% this past year. Whereas a perfectly healthy portfolio easily could have gone down that much. But the resentment or the impairment of hurt, as Chip might explain, can be, well, I'm never going to let that happen again. Essentially, I'm going to protect myself from hurt. I'm never going to let that happen. Whereas the gift of hurt can also be healing and courage. I think about a client, this one particular client we have, who was a very new investor. He sold the business years ago. And in relative terms for him, he was a really new investor. And he had a lot of worry in the early years of him investing his portfolio, a large chunk of money after he sold his business. And he asked for what he needed from our team quite a bit. But he asked the right questions. He asked why things will work out okay. And he really developed the gift of hurt. He experienced some healing and he experienced some courage, which, as Chip has on this chart, is the gift of hurt. Now he's actually a very courageous investor. In 2022, he didn't really worry at all. But the way he got there is that he was willing to ask for what he needed. I think the other emotion that really can impact investors quite a bit is obviously fear. Here's the interesting thing about fear. Anxiety can last a lifetime, but there's a lot of research that fear lasts about 90 seconds. And where that comes from is the idea that anxiety is the place that we go to when we're afraid, but we don't really know that we're afraid, or we're not maybe in a place where we feel safe enough to say, I'm afraid this might happen. Like a lot of our clients will say, I'm afraid this might happen. And we're, in the work we do with our clients, we're a safe place where that really needs to be voiced. Because what happens in a lot of those conversations with clients is we talk about making smart decisions. We talk about what we can control and what we cannot control. And what happens is more wisdom in terms of smart decision making becomes a result. Also, more faith in the process. Now, there are things like spiritual faith, which are extremely important. But this is, from an investing standpoint, sometimes this is just faith in the process. It could also be termed hope, maybe. Hope and faith that things are going to turn out okay. Sometimes we're not always given the perfect playbook for all of the struggles and challenges that we experience in life. But thankfully, in terms of investing, we're given a lot of history that we can really rely on. And many of you know the quote that you've seen, we've put in previous market updates. The quote from Harry Truman and even Margaret Thatcher said something very similar. The only new thing out there in the world is the history we haven't yet read about. And so, so I think a lot of faith can be taken from that, that even what's going on in our country, in the economy, in the investment markets in this past year, none of this is new. We've seen this movie before. It doesn't mean that it's not going to hurt. It doesn't mean we're not going to have some fear, but we have seen this movie before. So those are some things that I really wanted you to think about as we start this new year of 2023. For those of you that are clients, I just want to thank you for your confidence. I want to thank you for letting us continue to help you steward your finances in terms of making smart financial decisions. And thank you for continuing to remind us what you're trying to accomplish in life. We're very aware that there's a lot at stake in life because, and so therefore there's a lot at stake financially in terms of the success of your financial plan. So shoot us an email, call us if you have any questions about anything, and we look forward to talking to you very soon. Thanks.